2, 1. Let's jam.
I want you to know we were live before you even did that. Hello, everyone. Welcome to another episode of Pirates of Finance. Sorry we weren't here last week. Jason was indisposed, sick, hurt, crawling out of the hospital. Fortunately, he's all better now. He still claims he's got some illness, but the plan is to put him on the spot this week, get him asking and answering questions for once. He asks a lot of questions to avoid answering. I'm going to put him right on the spot. To kick it off, to remind you, I'm Corey Hofstein. That's Jason Bucker. Which way am I pointing here? We got Handsome Jack managing everything behind the scenes. Thanks for doing that, Jack. Huge shout out to Blockworks for hosting us. Thanks to all of you for joining. And finally, last but not least, this is just a bunch of guys chatting on a Friday afternoon. Don't take us seriously. None of this is financial advice. Seek advice from a professional, both medical, financial, whatever you need. Don't get it from us. How did I do that?
Corey, before I give you the chance to interject and start asking me the questions, I do want to
go right ahead.
Because I do want to apologize. Like I said, there's never any excuses. We don't want to talk about what happened to me because we don't want to get shadow banned on YouTube or anything. Is the to make up my penance or my homage to you, as I was trying to grow out my mustache this last week, just in solidarity for you, but you can't really see it on this HD cam, so it didn't really work out. So now I can't wait to shave it off. But I was trying to have some solidarity with you and that was my form of penance, was to kind of grow out my mustache to be more Hoff-like.
I appreciate that. I noticed that the market actually rolled over like literally almost to the day of me shaving my mustache off. So I'm not saying it was my fault, but I'm also not saying that.
All right, Corey, you said you said you were going to come on strong and give Jason a tough question. Let's give it to him. Don't right, take it easy on Jason.
Don't dilly-dally. Well, Jason, this is something you've thought a lot about. You have set up your career around the idea of building robust portfolios. And with Russia invading Ukraine, which I'm sure we'll get this video shadow banned now as a topic as well, it made me think a lot about the privilege of being an American and having almost the entirety of my net worth tied up in equities and in a bank account. And if we were to ever undergo some scenario where the US were invaded and markets were shut down and banks were limiting withdrawals, I would be effectively broke. And it made me think about sort of this concept of hedging yourself for the end of the world. Do I need gold coins in a safe? Do I need to bury something in the backyard? It can't just be gold bars. I need something divisible, something I can carry around. I know you've thought a ton about this. Talk to me from a practical perspective, some of the things you've thought through.
Yeah, I think there's multiple layers to this cascade. And I think the impetus came because you were in St. Bart's and we were kind of talking about Hugh Hendry's, trade for the end of the world. Is he said he bought a house in St. Bart's and that was his end of the world trade. And we were talking about what are the factors involved in that? And is that a good trade? When we talk about constructing portfolios, right, we talk about liquid, exchanges, liquid assets, and we need those markets and banks to stay afloat for them to work. And if those exchanges and everything shut down, right, then what do you have, right? Like you said, you have gold, you have cryptocurrencies, is the internet working? So there's the first level of cascade. Like, what do I use for money? Cash. Do I have so much cash in my house? Like, to me, I always think about, you always want some cash on hand. I mean, that's just smart, right? Like there's also like layers and levels to this as far as prudence, right? I think Tucker Max wrote like a recent thing about prepping that everybody kind of glommed onto, but there's like layers of prepping too, like having enough.
Tucker Max.
Yeah, you didn't know, like he's still pumping out
Tucker
content.
Max from like 20 years ago who wrote the horribly inappropriate stuff.
Yeah, he wrote a whole thing on prepping that like is really making the rounds in the last few months, especially among like the Silicon Valley types. And so the idea though is like, do you need to be, bunker prepping and everything? Probably not, right? Because at that point you need to be making friends with the CEO of Blackwater, right? Because you're going to need a military to protect whatever you have. But in general, like you have things like the Texas freeze, or like we have earthquakes and fires in California. Like you're going to want like a 30-day supply of water or food, right? That's just natural. You should want those things on hand in general, whether that's a pump for your pool or you're constantly kind of adjusting, a 55-gallon drum of water, having, stores of food on hand. So that's one way to look at that I think is prudent for everybody. You don't need to go over the edge. The second is like, I explored this a lot, is like, yes, if you have all these liquid forms of exchange shut down, what you really want is a farm, right? You want a farm that has a good, adequate water source that can't be tainted upstream, and you want a bunch of ruminant protein animals, and hopefully some pulses and tubers and everything to fill out that diet, right? So you start looking at, okay, what does that look like? There's a lot of parts, America's and this is what you're getting to. We have this American exceptionalism. It's one of the greatest growing regions in the world, right? We have the most arable land in the center of the country. We're surrounded by oceans. We have protectable borders. More importantly, we have dual climate zones that can create insect die-off in the winter, which provides the NPK for our fertilizer. So we have all these like interesting components to America. And then you start looking at, when you need water, you're looking at rainfall patterns. So I started looking at land in Oregon and North Carolina primarily because this is where you can still get cheap land. You have, decent amount of rainfall. You can hopefully get a good water source that you need to check out, fracking patterns in wherever you're buying that land. So you can really start to go down these rabbit holes. But I think what's maybe a little bit more interesting is Sebastian Junger wrote a book called Tribes. And he's talking about building tribes, especially in your local communities. And what was really interesting to me living in the heart of Napa Valley, just a small community, is during COVID, is that you had I just got a shadow band right there. I just threw out the word when I was trying to avoid it. Is if you have these small close-knit farming communities, we could have potentially worked on the barter system. We really didn't have any sort of supply chain shocks and everything, because everything we have is grown locally and organically, and everything in the Northern Bay Area. We're incredibly lucky. We're 30 miles as a crow flies from the ocean, so we can still get that moisture even if we're not getting the rainfall. You can have ruminant animals that are feeding on that sweet, salty, seawater grass. So there's really, so if you can make close connection with your neighbors and you can come together as a community, and there's almost a way to crowdsource and barter. That's another way to look at it. So I'm kind of rambling, but I think there's you set up portfolios that can manage whenever liquid markets are going on, and we have that great privilege in America. And if those shut down, you're going to need food and water for a certain interim period of time before they maybe reboot. And then if they don't reboot, maybe if you want to really think down that line, you need to have a farm with a clean water source, ruminant animals, and tubers, pulses, grass, vegetables. I mean, maybe if you can get to that
too.
Right. And but assuming you live on it, that would be even better, right? Yeah. Or get there, or people have gold stores all over the world. It's well, we found out, also in the pandy that you couldn't get to your gold sources. So if you can't move the gold around because flights are shut down, well, you can't access your gold. So I think there's layers and levels of this cascade, and it's just basically how deep you want to go, what's pragmatic, and what enhances your quality of life, but also enhances your mental and emotional security. Is that fair? Is that how you look at it?
I have a friend who is ex-special forces, who said part of their training, one thing they learned was you should always, when traveling, have a Rolex on you, because no matter where you are in the world, you can probably trade that Rolex for a car, right? So thinking about that point, you've buried gold stores all over the world. No one knows where you will necessarily be when some global pandemic or horrible event happens. Hopefully it never happens, but right to that point, are you going to live your entire life on the farm and never leave and never go to a business meeting and never risk not being there? I thought it was a really interesting idea of what will work for barter at certain levels of the world breaking apart. I'm sure if you travel to any third world country and offer someone a Rolex for their car, given the world economy still going, I bet you can probably find someone to take that trade and get a car and go wherever you're going. If the entire world is broken down, I don't know what the demand for luxury items will be. I sort of suspect gold coins will retain their value, largely because they can work as that system of exchange when currency will no longer, at least paper currency perhaps no longer really works. But that we're talking everything is blown up. I was really more I think practically interested in this is this idea of countries that are next to Russia. Probably always in the back of their mind, people there have to think about the risk of invasion, or if you're in the Middle East. And again, in the US, we have this luxury and privilege that we think about it very little. And therefore, our investable assets can go into more productive assets. I can invest in startups. I can invest in equities. I can invest and help grow GDP versus putting money in, say, just gold or an asset that's not going to be cash flow generating or really productive in any nature that you might need as a hedge to the end of the world. And does that give certain economies like the US a structural advantage from a growth perspective versus other economies where people feel like they have to constantly be putting some of their net worth in these hedges? They're not getting as much money recycled back into productive assets.
Yeah, I'm trying to think of, like, without saying Maslow hierarchy of needs, because I hate it. Is that's essentially what we have? Like, we have this enormous privilege, right? That and you can throw money into VC because you're not worried about your security. By the way, I think can't remember if you and I ever talked about this privately. Like, my watch collection like saved my bacon in 2008. Literally, like, I converted my collection of watches to food for months and months on end. Like, that really, like, it was amazing. They still had value. And I was able to convert that value into food that actually sustained me in 2008, 2009. So, I mean, it gives you one example of, like, that was a great, Rolex trade. But just like, I mean, they were talking about the Hugh Hendry one too. Is like, historically too, you had the low-lying, like, fishing people would also make friends with the tribes in the upper regions to have the animals, and they would exchange, right? So what's more interesting to me is, like, not only that, what we trade, it's like, it's the relationships that we create. And that's what it always comes back to. And, like, during these times of stress, that's what it always comes back to, is relationships, right? If you're a refugee, how can you band together? How can you get across the border? How can you set up an encampment? Who can help you there? Who can feed you? And it's like, we get back to those really intangible qualities of life. But I also don't think there's not necessarily a false dichotomy here. There's no give ups here. Like, for example, not to harp on what you and I do, but, like, you talk about return stacking or cascading, right? It's like, you can be going way out that risk curve and investing in VC, but you still could be holding a little bit of physical gold, a little bit of physical cash, living on a farm. Like, you can have all of these things stacked in your portfolio. And that's the beautiful way that we're able to construct portfolios in America, especially, is that we have access to all these liquid strategies, illiquid strategies, and ways to kind of stack those returns on top of each other. So you could go all the way from having an isolated farm, but you're still a VC investor over Zoom and taking your meetings. Like, it's pretty phenomenal world we live in. And unfortunately, maybe, that's not the rest of the world, but, like, that's what, we have the privilege of being able to take advantage of.
To talk to Hugh's trade for a moment, and maybe we should explain what that is. Jack, you might have to come in here and explain it. But I do want to point out, like, he calls it his trade for the end of the world or whatever it is. It's really, to me, more of a trade for the end of the financial world, because having just come back from St. Bart's, there's nothing there. They're not growing food.
Right. They don't have any wheat. Like, there's no palladium, no silver, no aluminum.
There is nothing. You are not surviving on St. Bart's if they're not bringing food in. So
it is. Yeah, it's an importer of capital and an importer of food, for sure.
Yeah. All right. So maybe, Jack, you can explain with a little more clarity than Jason and I have as to what the trade looks like.
I think that the way that Hugh expressed the trade to me was, it's less about at the end of the world. Maybe he used that phrase, and more about just that very wealthy people will want to live on this island, and the price of that will go up. And it's there's only a fixed amount of real estate on the island, and the demand will just go up. So yeah, I don't know if he thinks of it as sort of a crisis hedge. I think he talked about it during March of 2020. Yeah, it's a financial crisis hedge, but, like, in a global World War III, I don't think he would think it's a financial hedge. Yeah. Also, I think it's important to introduce the concept of carry. Like, I think having a few gold bars, or even, like, a little slip in your pocket, the Rolex that you can trade for cars, that has a pretty low carry. But, Jason, buying a farm in a foreign, in another part of the country, and having someone upkeep that farm, making sure you plant the roots and the tubers and you have all the cans, that seems like that has a very high carry in terms of, like, it costs a lot of money, both in terms of time and money. So it's kind of like, buying VIX futures, very expensive VIX futures. It's like, it will protect you, but you're paying for that protection.
Well, it really depends on how you want to live, right? How you want to structure your life. Like, Jack, you're not far from the Hudson River Valley. It's got one of the most fertile soils in the world, because also, when you start going down this rabbit hole, you're going to start going down rabbit holes on permaculture and how do you build soil integrity. I mean, you go way, way down these. I mean, I've been way too far down these roads. But also, I think part of Hugh's trade too is he was actually talking about the absolute flex of St. Bart's, right? There's one of the last bastions in the world where people can flex. And then he was also talking about French banks willing them to lend them enormous amounts of credit at basically, like, almost zero interest. So that's part of it too, is, like, basically taking advantage of those different factors. The other one besides Rolex's, Corey, I forgot to bring up, is I always love the idea of, these guys used to insert diamonds, like a diamond into their bicep. And as you were traveling the world, like that was your last bastion hedge. Like if shit really hits the fan, if you're in some like, Burmese prison, you could slit your arm open, maybe use that, 1 carat diamond as your tool to get out of jail free, like kind of thing. And I always, I mean, it's pretty graphic, but I always love that one of like just a memento mori, or just a signifier of like, I can always get out of this situation because I've got a diamond sewn into my arm.
I'm literally speechless. That's one I've never heard before. That's wild.
I love that one. And so, yeah. And so the other, but part of that too is like, they also, sorry, I'm going to go down a different rabbit hole. Is like in Brazil, they talked about implanting chips in their children because they were getting kidnapped so much. But then people were like chopping off arms to get rid of the implants. So you always got to be worried about all the different ways you're storing wealth on your body.
By the way, Jason, sorry. We got a comment from Carson Emery who says that's a terrible idea.
I didn't say it was a great idea. I just thought it was an interesting idea. So I think where this kind of leads to, I think actually this gives us a jumping off point to maybe talk about 6 different subjects. But I think like we need to talk about this LME, this London Metal Exchange, and this nickel trade. And I think because it opens up a lot of subjects, and hopefully I hope the audience is going to hear Corey and I talk about this in many ways, but we don't necessarily have an opinion. Like, I mean, there's a lot of both pros and cons to this, right? And so maybe we can hopefully definitely walk through this a little bit, but I want to start out with the basics just for people that don't understand futures in general. Is you can use a lot of margin or leverage in futures, and it's very different from stocks. So like if you want to borrow against your stocks, you have to go to your broker and they're going to charge you a fee to borrow. The way futures work, like I'll just do a real toy model simplicity, is let's say I was trading the S&P 500 futures, and let's say they were $100. Well, I only have to put up a performance bond of say $5 or 5% to control that position. Because let's say this goes back to all our discussions on volatility and VIX. Let's say vol's at 16. So we're expecting 1% plus or minus moves a day. So then my exchange is going to say, if you post 5% as a performance bond, we're well within those bands where if it goes up or down, you're going to be able to cover that cash position. And we're going to mark to mark that daily. It's actually twice daily, but you get the idea. So that's the idea, is like you only have to put up 5% or like $5 out of 100 in this case scenario to control $100 S&P. And then that's commensurate across all commodities. They have different margin requirements, etc. But this idea, it's usually about 5 to 10% is your performance bond. Now, what happens is as soon as volatility starts to ramp up, then the exchanges, the prime brokers, the clearing houses will ask for more margin. And so this is where people can really get caught. So the idea is like as volatility goes,
So,
yeah, please.
So just to be very clear, what every day that collateral is being either added to if the position went up. So let's say the S&P went up $5, and you had one contract, you had another $5 added to your account. And if the S&P went down $5 would be swept out of your account. So just to be clear, every day that the reason you don't need to put up that much is because you're not buying all the underlying, you're just buying the performance from where the S&P is.
Yeah, the maintenance margin, your maintenance margin, your mark to market daily, and essentially then you become a margin or drawdown manager. So, but then where it starts to get sticky is when the markets start moving faster and they require more margin. So let's say you're expecting a 10% drawdown in the market. So you posted, 10% for your drawdown, and say you're expecting a 10% margin. So you're sitting on 20% cash, but now it drops 10%, and then they raise the margin requirements double or triple. Well, now you need 40 to 50 cents on the dollar, but you only posted 20 cents. So now you're underwater. And so that's what it's about. You have to have enough for the drawdown. And then when markets start getting faster and time picks up and it starts getting more volatile, they're going to require more margin for those positions. So what will happen is, you have, when you're trading at like CME or CBO, you're going to have position limits as a speculator. But when you're actually a producer of those commodities, you can have higher position limits. And so this is, Corey, you and I were going to go back and forth on Twitter about this, is like the idea of path versus terminus, right? So if I'm a producer of nickel, but I'm producing the raw goods and it's going to take me a few years to get to market, I want to be a hedger. I want to hedge that price risk. So I want to short the futures market so I can lock in my price, which is fine when we get to the terminus of the finished goods and I can deliver those finished goods, right? But the problem is in between, if the markets get volatile and there's a short squeeze on nickel and margins go from 10% to 50% to 150%, I'm going to get blown out on that margin position. So the path of the margin blows me out, but not the terminus of my position that I actually hedged with the physical. And this is what people are missing, is like the terminus versus the path to get there. And this is kind of what happened in the nickel trade, where you had a large Chinese producer that was hedging their position. had a large short position, and they did not, the margin calls came. They didn't make margin calls. The London Metals Exchange let them go and didn't make them force those margin calls. And so the position got out of control in a short squeeze. And basically nickel went from $25,000 a ton to $100,000 a ton. And so basically the losses are 8 to 12 billion. But yeah, please step in.
Yeah, I was just going to say, just to like make that super concrete with an example, because we're using a lot of terminology. So again, there's this nickel producer who says, I know for certain I will produce 100 tons of nickel 2 years out. And you want to know what? I'm very happy to sell that nickel for $50. And so what they do is they're going to short those forwards or future contracts 2 years out, because they know they can deliver and they're happy to take that price. The problem is, in the meantime, they have to post that collateral. And if the price of nickel goes up enough, their collateral gets eroded and they have to keep coming up with money and keep coming up with money, or they have to close out their position. And then in closing out and buying to close, they can drive the price away from them, creating an increased short squeeze. So even though they know for certain they can actually deliver the physical in 2 years, along the path, they can get squeezed out of their position very violently. And that seems to be exactly what happened in the nickel market.
I've got a question.
So why, we're talking about things like,
sorry, Jason, why would someone ever have to post 150% collateral?
As the prices move, both the FCMs and the clearinghouses can change the level of collateral to whatever they want.
Okay, but isn't with 100% collateral, wouldn't you never go broke, right?
Well,
I'm just saying
the price. If you're short, you could lose infinite amount.
Oh,
of dollars.
right. Okay. Fair. Yeah.
So you could have to post way more because the market's moving so fast.
So in this situation with the LME and nickel is like, this is why we're saying on how do you solve for these, right? Like on the CME, we have position limits and everything. And hopefully you have quicker API calls, so to speak, to make sure you have to post the cash or collateral for that margin. The problem was the margin got away into the billions before they made when they made the call, because we're, running off of cell phones and phone calls and fax machines still at a lot of these exchanges. And there's been innumerate problems with like LME going back a decade where people were concerned about these kind of issues. But just so people kind of know the structure of the way these things work too, is like, not only as a trader, you have to post your performance bond. Your introducing broker, prime broker, has to cover part of your collateral too. That then goes up to the FCM, who also has a reserve fund to cover your collateral as well. That then goes to the clearinghouse, who also has an emergency reserve fund as well. And if all those get blown through, then they go and claw them back from the market participants. So there's multiple layers of redundancy here that's hopefully gonna, and we're gonna get into it. This is still moral hazard. Like, don't get us wrong. We're not taking down either side of this. I'm just trying to explain kind of what goes on. So then the question becomes, in a scenario like this, where you have somebody that actually possesses the physical commodity, it looks like an interim short squeeze. The question is, do you blow that participant out? That's likely your largest revenue source, because I think it was over the last 2 years, they've done 40 billion in revenue off of nickel alone, right? So I didn't even look into they're probably the largest trader on the LME, let's be honest. And so the other the service participants, the small brokers, you might have had to blow out 12 small brokers and make them go bankrupt. And what is the the cascade of consequences because of that? Or do you do the moral hazard? What they do is shut down and said, no, we're marking it back to $50,000 a contract. So what I'm saying, I don't think there are any good answers here, but what I think it is begging, there's moral hazards here. There's what do you do in situations like this? And then the third order effects that I think Corey and I should more talk about is like, this is the world we live in, right? We're living in a highly levered world. No matter what exchange you use, no matter what instrument you trade, nobody wants to admit that it's a highly leveraged derivative world. And if we have to all go to cash at the same time, it's going to be absolute chaos. And that's just the way the financialized system works.
So 2 points I'll make. First is I was using the wrong mic this entire time. This wasn't even turned on. So I guess I'll make a couple points. Second point is, this is when you might hear about people degrossing and forced degrossing and technical flow in the market. This is some of the stuff we're talking about, that when markets move faster, margin calls start to happen and people are forced liquidated. And these are sort of non-economic transactions that can move markets very violently, because you typically have all these parties having to act in the same way, right? It's either they need to sell their position down to raise capital, or they typically have to raise cash somewhere else. And so what you tend to see in the most violent throes of a market event is even something like a safe haven like treasuries will get sold off as people are quickly trying to raise cash to meet margin demand. So you saw that March 2020 is that even, treasuries, which had gone way up, even they ended up having such an increase in margin, and there was so much demand for cash out there that treasuries started to get sold off. One of the questions it raises for me is the whole point of these markets, at least in theory, is that producers can come and hedge out future risk. But there's, again, this interesting dynamic of sort of, as you put it, terminus versus path. And is there a better way, right? Like, why should these producers have path dependency? It's only a risk to them. And maybe that's why there's a risk premium for speculators. But, I don't know why, if we want a functioning economy where these producers can deliver assets, like, why should they be taking path dependency risk?
Well, there is like agricultural banks, commerce banks, but I always love that. There was a great post. God, was it Joel that put it up the other day? So sorry if I don't get it correctly, but the last line was, banks will do this for you for a fee. Right. So it's the question of like, will the bank take on, billions of dollars on price risk hedging? And then what is the commensurate fee? And then is it cheaper to do that on the LME? So I think that's what it boils down to, right?
Yeah. So,
but let me ask you this. What would you do? What would you like? So this scenario, right? The ideal world, we have position limits. We have real-time margining. So as that position's blowing out, they have to post collateral, or they get completely sold out, right? Automatically liquidated. And this would be the, people would understandably say this is why blockchain would be fantastic. You can have real-time margining, real-time liquidation, assuming your API calls get through. But outside of, once this thing gets away from itself, what do you do in this scenario? That's what I'm saying. Like, everybody is upset. I'm upset. There's moral hazard. It shouldn't happen. You shouldn't have to exchange with, trade. Like, the people on the long side should be paid. But like, that's all in theory. But in practice, you either have a cascade of consequences that blows up the entire like kind of LME system, or the people on the long side are they're gonna get clawed back their gains on their paper gains on the long side. I'm not saying, like, don't get me wrong, there's moral hazard. It's incredibly
well, the facts are evolving,
annoying.
by the way. The facts are evolving here. There seems to be now a tie-in with JP Morgan, who was on the
I haven't read that part yet. Yeah.
That part just came out this afternoon, and I haven't read it either. But I did see that they were potentially counterparty to this trade, or counterparty to the Chinese nickel producer, as well as the LME, I guess, is owned by a Chinese exchange. It's
owned by the Hang Seng, which is owned by the Hong Kong exchanges, and then also it's serviced by the Chinese, commerce bank. Yeah, like there's a whole. So
there's all sorts of weird. Yeah. So, but I guess maybe I'll take this question a different direction, which is, there is, like, this isn't just financial markets anymore. There's real economic good to this practice, right? And we need for producers to be able to manage their businesses. They want this ability to hedge. And so I guess the question is, okay, you blow up this massive producer and you do real economic damage. Are the speculators on the other side of that trade going to take their profit and suddenly turn around and reinvest in nickel producers with that profit? Or do you end up with a nickel producer going out of business, one of the largest in the world, and all of a sudden there's a massive shortage of nickel in the world? And it's going to take some time to bring that supply online. I mean, you could say, the free hand of markets, someone will step in and buy it at a discount and get production up and going because it's a good opportunity. I don't know, but it seems like at the very least, it's creating a time gap between when that nickel can then be produced again. And so you enter this really interesting moral question of, like, when should the financial markets be destructive to the real economy?
I've got a question, which is, how come the Chinese producers doesn't just sell the nickel to settle their debt? And if the answer is it's not ready yet, then my follow-up question is, sounds like they had a asset liability mismatch. It sounds like they were short too early of a contract. They should have been short the December 2022 contract instead of the May 2022 contract. So someone in their treasury department is to blame. What do you think of that take?
This is the LME's actual. This is what the LME is saying, is like they actually can produce it. They just can't deliver in this time. The short squeeze is an irrelevant temporal time frame. So in the long run, prices will come back into line. It's also why he's saying he's not taking off his hedges. He's trying to play chicken with the LME as well. And so that's to your point, Jack, is like, yeah, well, can you time it perfectly? Can you get the right contracts on the right quarterly cycle? Probably pretty difficult. But yeah, that's kind of the overarching theme, is like he has it. He just doesn't have it right now. Right.
And
he doesn't have the cash
liquidity there too.
Exactly.
Right?
Yeah. It's not easy to sell nickel, I wouldn't think, in large quantities or at different stages of finish. But Corey, bring it back a little bit, because this is bringing back full circle to like kind of like you were saying, like what's the end of the world trade is like. When this is something I'll be fully transparent about, it. It's like when we were building our firm, we specifically wanted to only trade in listed exchanges, right? This is why we purposely built our products and futures and options, because of this performance bond, this cash collateral, this mark to market on a daily basis, and all these redundancies that you see with like CME and SIBO. But what we haven't seen is a clearinghouse get too big to fail yet, right? And we haven't seen, and so our question is always like, if the CME or SIBO gets like too big to fail, I think obviously the government steps in, which is unfortunate, moral hazard, but like that's the kind of scenario we live in. But like we didn't want to, especially when you're doing long volatility or tail risk contracts, we didn't want to use the over-the-counter party risk with investment banks and third parties, because what if they, like 2008, they owe you billions of dollars and they say, sorry, we're not paying, and now you go to court for 3 years and your money's tied up. Who cares, right? So if you can use these listed exchanges, at least you can get that cash sweep on a daily basis, but now you're opening yourself up to what we're seeing now as clearinghouse risk that nobody's really thought about. And so then the other question then becomes, okay, if this happens at a clearinghouse side, once again, that means the entire global markets are shutting down. So now it's back to guns and butter time, right? And ruminant animals and good water sources. So it's kind of like tying that all back in, is like when we live in a financialized economy where we like to make these bets about which way the world's heading on commodities, financials, et cetera. This is kind of like a system you get in where it makes it convenient for people to trade things on paper and on computer screens.
Yeah, I don't know if there's a question there, but I 100% agree. Like you can build that portfolio for, right, that all-weather portfolio that should be able to weather any economic storm, unless it's a financial economic storm that takes down the financial system, in which case that gold ETF you have is not going to be accessible, right? Like it doesn't really matter. And so then the question is, do you sacrifice some of that efficiency, cost of carry, all that sort of stuff to have a part of your portfolio where you need a hedge? And the question is, how much of your portfolio should it be? I mean, is it enough to have, I don't know, $5,000-$10,000 of gold coins, in a safe? Because if it truly is the end of the world, my guess is that $5,000 to $10,000 will be worth a lot more than 5 to 10, right? But what if people don't adopt gold coins? Right?
Yeah.
Who knows what they're going to take? And so, yeah, it's probably at the beginning: food, water, shelter, clothes, ammo. I mean, I'll tell you what, if the world comes to an end, I will pay a large premium for size 13 shoes. Trying to find those is going to be a pain in the ass. Being an average height human, Jack, you know what I'm talking about.
Oh, for sure. And Corey, by the way, you talked about gold coins. I think I would definitely like to hold a lot of sort of Greek drachmas or like ancient Roman legionaries coins, because I put a high probability range of, in this sort of post-apocalyptic scenario, if we are talking nuclear scenario, Fallout New Vegas, there was, the Caesar's Legion. So maybe those coins will have a lot more utility. Also, Corey, you did the thing that is the classic, like, guest getting a little bit of attitude, which is, well, like, hey, excuse me. Sorry, my dog came in. Which is, like, I didn't hear a question there. I didn't really hear a question there. That's kind of like a thing when a guest, when they're getting a little bit bratty.
Yeah, well,
Corey doesn't get his yes and. He didn't get his. He didn't get his yes. By the way, you guys are much more heroic than I am. I'm going to use my cooking skills to just facilitate the tribe, or like in the beginning of Cormac McCarthy's The Road, I'm going to go out like the wife did. See ya. Thanks for playing.
Wow. Okay. That's a
I always go dark.
Someone on Twitter said something to the effect of like, you want ammo, food, shelter, clothing, and big friends. And I was thinking to myself, like, I feel like being big at the end of the world is a bad thing. Like, you're a big target. Like, just because I'm big doesn't mean I know how to fight. I've seen, like, that tiny guy who knows mixed martial arts could definitely kick my ass. So it's like, big friends aren't going to help you. They eat a lot of food, run in a small tribe.
But it's all about image. It's all about appearance.
All right, let's turn this thing around. What else do we have on the agenda to possibly talk about before?
Okay, we can go with moral issues with being long commodities, or why an increasingly complex macroeconomic picture may lead to larger magnitude moves.
Corey, it's dealer's choice for you. I'll let you take a sip of your water, so I'll just out of that beautiful glass skull you have. But what do you want to talk about?
Crystal skull. Well, let's do the second one. So where this came up for me, and this is something I posted on Twitter, I was just thinking about how complex the macroeconomic landscape has become, right? COVID turns into supply chain shocks, turns into increased demand, turns into inflation risks, and then we have sort of latent stimulus effects. We then get, is the Fed going to raise rates? What are we going to do about inflation? We suddenly get a war. We now have massive supply shocks coming out of Russia and Ukraine with wheat, oil, potash. We just have an increasingly complex macroeconomic landscape. And I think we've been conditioned over the last 15 years for really fast market events, right? Fast sell-offs, fast rebounds. Everyone just wants to rip the Band-Aid off, get the sell-off over with. And I think that's because a lot of those sell-offs were technically driven, not driven from a macroeconomic perspective. And I think when things are driven from a macro perspective, you can't rush the realization of macro events. They're going to play out as they're going to play out. So not to go to extremes and horrible extremes, but does Putin use a nuke? Well, if the market prices that at, say, a very low probability, and then he does, right, the market's going to react very violently, but there's no way for the market to react prior to that event. It's sort of like, a one that we experience in the US every 4 years would be like a presidential election. Like, you need to wait until the results come in before the market can react, typically. And so I guess my point is, like, is this style of market very different because we have all these macroeconomic events going on? And does the magnitude, the sheer number of potentially conflicting macroeconomic events make it very hard for the market to price any individual event? And so if that individual event is realized, the market has to reprice more rapidly and violently.
Great. I do want to put a pin in this because this is complexity theories and complexity dynamics, and I want to really get to that. But this will help. I want to illuminate it a little bit better too, because while I was in recovery, you clogged up my YouTube feed, and I saw you on Value After Hours. So shout out to Toby.
Shout out to
Jake
Toby,
and
who's in here.
Yeah, I saw Toby, Jake, and Bill. And so on there, though, you brought up Ragnarok and what is it, Fimbulwinter? So I think this also helps explain this, and it gives us a way to talk about it. So explain what you were thinking about Ragnarok and Fimbulwinter versus technical sell-offs versus long-term sell-offs.
Yeah, so I don't know anything about Norse mythology. This is just a good sort of Chris Cole sales situation. But everyone sort of has heard of Ragnarok, which is like the end of the world. All the gods die in a giant battle. And the world is reborn. And it's a very sort of violent end of the world in Norse mythology. What comes before Ragnarok, though, which is sort of the cataclysmic end, is what is called Fimbulwinter. And Fimbulwinter is this sort of never-ending cold and dark. I think they say it's like 3 years of never-ending winter. The sun never rises. There's no summer. There's no food. It just drags on forever, and it seems like it's never going to end. And so sort of the point I was making was that we've been very conditioned for these Ragnarok type events. Like, I hate to say it, but people almost want another March 2020 because everyone knows to buy some puts and profit, and great, the market's going to rip from there and the Fed's going to step in and bail us out. But what happens if this is a slow economic decline where inflationary pressures slowly build into earnings losses, right? And individuals start being unable to pay debts. And, you could sort of see this slow unwind that leads the market into a slow grind lower for 2 or 3 years. And that's very painful to deal with. It's hard to hedge other than just taking off risk assets. and emotionally, it's very difficult. You sort of like lose the fun of the market just going up, and it feels like it's a never-ending winter of sort of pain. So that's sort of the difference. Like,
and that's why I thought that gave us a good theme to talk about what you were asking before about the complexity of markets currently. And like you said, I think it's really interesting to think about that. We haven't had a 2 to 3 year like recession. We haven't had a decade or two of seeing like the S&P underwater like we've seen historically. People are completely unprepared, like you said, for that pain trade.
And by the way, markets around the world have over the last decade, ex-US. The US has just miraculously avoided it.
Yep, we got Michael Harris pointing out or emerging market type 2011 to 2017 whipsaw. Right. I'd also add that there's a classic statement in volatility. What is it? Stairs up, elevator down. Like things go up plus 10 basis points every day, and then when they go down 3% a day. Down 15% in a single month or something like that. But Fimbulwinter, Corey, kind of sounds like stairs down. Like you're just and money is just drained out of financial assets drip by drip.
I mean, I think people remember the Lehman collapse. But markets rolled over in June 2007, which was 12, 13, 14 months before the Lehman collapse. I mean, the market got very violent in Q4 2008, but it had been selling off for quite a while before that. And it was not, necessarily every day a violent move downward.
I wonder if the Pullover anecdote is not data, but I was thinking about this when you were bringing it up on Wednesday, is like the idea of, 70s, was the last time we saw a deep, underwater mark for a decade for S&P, but obviously, CTA trend following commodities did really well during the 70s, during that stagflation environment or whatever you want to call it, that and whether that's unique or not. And then we think about, 2000 to 2002, don't quote me, but I want to say SocGen trend index was up like 26% in 2001, right. Another 12% in 2002. So that's the question, is like portfolio control. Like, okay, these things can happen. You can have the stairs down and we can be underwater for a long time on, let's say, stocks and bonds. So how do you construct a portfolio to manage through those scenarios? Is it commodities? Is it CTA trend? Is it deterministic cash flows from private, alternatives? Like, how do you think about that?
Well, I mean, I think you have sort of two options. Well, you probably have more than two, but the two most extremes, probably you build that portfolio that's all weather, that you don't care what the season is. And when it's summer, you're going to lag behind, but when it's winter, you've got everything stored up, right? And that's probably something that looks like, the cockroach portfolio you've built, that it's a mix between equities and bonds and commodity trend and some long vol and all sorts of different exposures, so that none of them are ever fully in control of the portfolio. And so no matter what's happening in the markets, you have something that's hopefully working and balancing out your losers. And then the far other extreme is trying to time this stuff, which obviously is maybe the holy grail, and it's the holy grail because it's so incredibly difficult to do. I don't know what the answer is. I would say you might be able to meet somewhere in the middle. Go halvesies. Halvesies is sort of my favorite investment term.
I saw your tweet for that today. That halvesies, always halvesies. And then like part of it, like I said, deterministic cash flows are great too. And then people, throw that baby out with the bathwater, especially when they're not mark to market. And so you can sleep at night. And if nothing's really churning in your liquid portfolio, at least you got, monthly or quarterly income coming in. It may not be great, and we may be in an inflation or deflationary environment, but it always helps you sleep at night. Having some cash flow is king at the end of the day. And but I want to go back what you brought up about the complexity of the markets, and you had some great images you've been putting out of like what it makes you think like if you understand the markets or not. And this is kind of one of my bugbears. So I do like that you brought it up. Is that I hear people all the time, especially older people, will say, "I just don't understand these markets anymore." And when I was younger, I understood them. And I'm like, "Did you?" The markets were just as complex then. It's just your testosterone and ego was so large that you thought you were a big swinging dick, master of the universe, and you thought you actually knew what was going on in the markets and you had a handle on it, primarily because you had a positive P&L and you were riding a 40-year bull market. Like, so did you really understand the markets, right? That's part. So part of it is like back in the day, I used to do all this coursework with Santa Fe Institute in Stanford on complexity theory, right? And if we start talking about complexity dynamics, is like complex systems create what we call emergent properties. And emergent properties is a fancy word for saying, I don't know, right? And so if you have a complex system, we can't understand that determinism in a complex system. So we can't really understand a complex system. But then what's worse is that when you have a complex system, that's what's called integrative complexity. When it interacts with another complex system, now we really, really don't know. And so we start talking about global economics and everything, what's going on in Russia and everything. It's like, you're not talking about complex system integrating complex system integrating with complex system. We have no idea. The idea that previously you thought you had a handle on it was a false conceit. That's the way I think about it. It's just pure hubris. And so you put out a great tweet too of ask me about, what happens if, QE or QT, what does this do to rates and everything? It's like, if the whole economic system worked, like if I pull here, this is what happens, then we'd all be Ray Dalio. But it just doesn't fucking work like that. Like it just, there's what we call negative externalities, unintended cascade of consequences. None of us truly knows, right? I mean, I know once again, you're gonna be like, is there a question in there? This is another one of Jason's rants, but it's interesting to me to people's like, I don't understand the markets. I'm like, did you ever?
No, I think that's spot on. The picture I post is this. People might be familiar with like this famous painting of Napoleon on a horse, and there's a digital artwork style called, I don't even know what it's called. It's like they use artificial neural networks to like manipulate the images, and it's this weird sort of methodology that keeps, how do I describe it? Keeps the structure of the original image, but everything within the image is all sort of messed up. And so that it is Napoleon on the horse, but if you try to look at it in the individual piece, it's almost like your eye slips off the image. It's complete nonsense. Yeah, there you go. And so if you zoom in on any of it, it's like the form is there, and then you try to dig into the details, and it makes no sense. I was having a conversation with Mike Green yesterday, actually, about this, where so much academic literature and so much market commentary assumes a they, and we never ask who 5 times, right? We never get to the core of who is doing something, and we never get to the core of how they're doing it. It's just they are taking off risk. Well, like, why are they taking off risk, and who are they, and how are they taking off risk? But we never can answer most of those questions on the day-to-day. And so I think the reality is the more you press to try to understand markets, the more you realize day-to-day they are almost impenetrable from an understanding perspective.
Corey, it's the bond market. The bond market. It's the bond market.
It's always the bond market.
But this is the problem, like with a lot of financial news and causality, right? It's all premised on almost like the great man theory, like you're saying, who's moving the markets, who did what, and it's not that simple, right? There's a lot of emergent properties. By the way, Michael Harris, always love the comments. This one's great, guys. 1966 to 1982 in SPX, old brokers told me they spent 10 years playing chess and one order from customers per week in large houses. That is a phenomenal anecdote from the last time we were underwater. But also, Corey, I want to bring up the Napoleon thing you did is just another perfect example of this. Is like our minds play tricks on ourselves anyway. Our lens of seeing the world is obfuscated through a subjective lens. So even when I'm looking at the picture, I formed Napoleon's horse, even though it's not there. Like we see what we wanted, like Anais Nin, like we see things not as they are, we see things as we are. And so we
see the pattern we've recognized before, right?
Exactly.
Yeah. I don't know where that leaves us.
Guys,
Jack, when this wasn't a live show, I just would have edited all that out.
Yeah. It's better. It's better that we keep it all in. But I will say, guys, we're 47 minutes in, and I haven't heard a prediction on the price of oil. Jason, are you? Where is WTI headed? Are we going back up to 140, or is deflation in the cards? -37. Yeah.
I'll take.
I need to know, Jason. I need to know. Where's the price of oil going?
This is one of the things you want to talk about, but this is actually it's interesting. My girlfriend and I were talking about when the prices at the pump in California are obviously through the roof, but we also run a commodity trend fund, and so that's my hedge against my food and energy costs. And then now the question that you guys wanted us to talk, one of the questions was brought up is like, what are the moral hazards with trend following commodities when you have price spikes or these different issues going on? And I don't know how technically to think about that. Like I don't root for energy or commodity inflation. I don't root for markets to go down. I have friends and family that are just primarily long S&P. I hope the good times keep rolling for everybody. I hope we're awash in credit and it's all lollipops and fairy dust. but we do build portfolios to protect our clients in case of like these exogenous events like this, and hopefully it protects their purchasing power parity. So I think I'm not sure if there's a moral hazard there. Corey, you might think about that differently than I do.
Well, I guess the key question I would ask is, does spot move to futures or does futures move to spot? Which is, I think, an important question, right?
Right.
Because if spot moves to futures, then driving futures up with something like trend following during an economic crisis can lead to real economic impact in a very negative way. And so it's, in a weird way, like war profiteering.
Or does it lead to market clearing prices? You get to market clearing prices faster.
Yeah. But go back to our example about nickel, right? Like, there's real economic harm in putting a company out of business that was trying to hedge itself to deliver real nickel into the economy at a further date, and they had path dependency risk that knocked them out. Like, that's a real potential problem for the economy, and I think it's open to interpretation as to whether it's a net positive or a net negative in the long run. From people I talk to, though, the answer is that spot does not move to futures. Futures moves to spot. In other words, producers go, this is my price, take it or leave it. Right? They're the ones setting the price. Futures might be trying to forecast, or certainly there's some sort of like risk neutral hedging properties that are going on with the futures. But at the end of the day, the producers who are selling know what return they need to get to stay in business and have a profit. And so they're going to sort of try to demand that price.
Well, I think once again, it's an example of terminus versus path, right? At the terminus, it's the producers that are demanding exactly what they want, right? And it's almost like that football of bond returns. It's like, we know what the terminus is. It's just all of the excitements in the interim path, right? And the margin requirements and the volatility. It's really perverse, really, at the end of the, like, it's just like we're bouncing around this path, but we all know where we're headed.
Yeah, and I think that's right. And I think there are cases where producers can have a windfall from where futures are, and there are cases where producers can potentially be hurt by futures because they are trying, in many cases, to hedge their risk using futures. But at the end of the day, they're the ones actually delivering the physical commodity, and they're going to try to transact at prices that make their business viable. And if the business isn't viable, the commodities aren't getting delivered, and guess what? The prices are going to go up.
And Jack, I do know exactly what I did, because in my head every day, I think about the John McEnroe quote when he's on the court. He's like, answer the question, jerk, answer the question. I have no idea where oil prices are headed. So that's my answer.
Yeah, no, and I know your answer. I know you're not a narratives guy. So I was asking that sort of as actually a prompt to sort of trigger you to talk about how sort of narratives.
Well, Jack, you also didn't say what time frame.
Yeah,
that's true. It's kind of like pick your poison.
But to that point, what's been interesting, and I'm sure, I don't know how many people are paying attention to this, because I don't know how many people are primarily, traditional financial markets versus like commodities, is like CTAs and CTA trend followers, like commodities, have exploded this year, but also this first week of March. But just like this nickel trade is like, your longs can get erased like overnight, as much as giveth it, take it away. Like that leverage and everything can mean revert on you so hard. So as much as some of them are producing eye-popping numbers that first week of March, they're also coming back in this week. So,
especially
in
in those markets that were limit up, that are now limit down, right? You can't even get out of your position. So the question is, how do you risk limit yourself in many of those? And they're all chasing, and they're all trying to exit at the same time. So it's a crowding problem for sure.
Well, that brings back up on the nickel trade too. Is like there's circuit breakers, right? Like in the CME, like CME and CBOE markets, right? Like if S&P moves 7% in a day, we have a 15-minute circuit breaker to make sure markets are functioning properly. If it moves 20%, market shuts down for the day. And in commodity markets, we, like Corey's saying, the markets will shut down on a limit move. And I wish I could find it on Twitter, but somebody put it perfectly the other day. As soon as a limit move happens, even in your direction or the opposite direction on commodities, there's nothing like being in that position. It was like somebody had this great graphic. It was like, just when you thought like you were getting fucked, the fucking was just getting started. Like you just get absolutely crushed in commodity markets when you can go days, weeks on end with limit moves, which means you cannot trade. You're just sitting watching your evaporating P&L, and there's absolutely nothing you can do. And so until you've been a futures trader, you have no idea how desperate you could be.
So, Jason, I know you hate macro, so let me ask you a macro question. we have this scenario now where there is economic sanctions against Russia. Russia has come out and said, or at least from what I saw a couple of days ago, that they would not be exporting any oil till December 31st. They're banning all exports to Western countries, which sort of creates this interesting basis between Russian commodities and non-Russian commodities. And China is potentially the only player that can arbitrage that basis or will be willing to arbitrage that basis. So what's sort of the play here, right? I mean, is it, if China does arbitrage that basis, what does that mean for commodities everywhere? Does it sort of trickle the commodities into the world, or does it risk sanctions on China? Or does China want to play nice with the West? I mean, how do you see this playing out? I know you hate doing this, so let's do it.
No, actually, I'm going to take it and I'll answer it by going on a different tangent in a way, like a tangential tangent. Is that you and I love this as far as like, and I think like maybe Luke Groman and some others have talked about this. Like, what if, Russia like just says it's crazy gold price for our oil and they just do it with China and everything. And then there's an arbitrage that only maybe China can take advantage of. But once again, you called it an arbitrage because as we know, arbitrages always get arbed away. Right. And so it reminds me, you and I have a deep love for Sam Bankman-Fried, SBF's, cash and carry trade when he was moving, money through Japanese banks, trying to take advantage of the arbitrage of Bitcoin in, pre-2017. And it would be a simpler scenario. It's a similar scenario. It's like, once again, I'm, I hate global macro because I don't know the cascade of consequences that would happen from that. But initially, it is an interesting arb trade that maybe only affects Russia and China. And then that arb trade closes over time because as you're moving physical commodities and physical gold around the world, you have transportation costs. You have, inflation, deflation. You have all sorts of different dynamics that are going to open and close the margin on that arbitrage. And so that arbitrage will go away. So does it create an arbitrage? And is it full of sound and fury in the end, signifying nothing? Is that kind of what you're asking?
Well, yeah. I mean, I guess the question is, right, does it help ease the commodity, the supply side commodity price pressure, right? If China's sort of backdooring the sanctions and bringing those commodities out and then potentially they're reselling them or not then having as much demand from commodities elsewhere, does that, help eliminate some of the price pressure on the supply side that the sanctions could be there and still, you could see commodity prices decrease? And then as an investor, is there a way to profit? I saw a note from Zoltan at Credit Suisse who was saying sort of long freight, right? If China makes this play, they're going to need a lot of boats.
Right. I was about to say, how are they going to get it? But that was my next question for you. Yeah, I was like, there's no pipelines going into China from Russia.
A lot of boats.
Exactly. A lot of boats and facilities. Those port terminals aren't that big.
And you can probably watch that, by the way. There's probably resources where you could start watching ports and see how much boat traffic picks up to see if this is happening.
Yep, and I know just the guy who does that. I'm not going to say his name on stream because I want to keep him for myself. But
right, text me, Jack.
Yeah, I will. But I just looked up the Russian oil fields, the map, and all of it is east of Moscow. But yeah, they do not have. I mean, I've heard that people say that to build the pipelines from Russia into China would cost something like $1 trillion, like the full project. So, and does that take a day? No, it takes years. And in that time, the price of oil could go a heck of a lot higher.
And this is why I defer. Like, I have no idea what I'm talking about. And I love deferring to like Rick Rule on this stuff. And just, I could listen to him talk for days about just like how many decades it takes to actually build up the infrastructure if you wanted to do something about this, even in the most like advanced countries, as far as like cutting through red tape, like how long it would actually take to build terminals and stuff like that for these kind of things. Not only the cost, but just the actual time.
And this goes back to my point about the Fimbulwinter, right? Like March 2020, as much as it was an economic shock, there was huge endogenous market events, technical flow that happened that sent the market in a massive, into a massive abyss. This sort of stuff that's happening right now cannot be fixed overnight necessarily. Unless all of a sudden Russia calls off the war, decides to play nice, repatriates, and everyone takes all the sanctions off, and then we all pretend nothing happened. Like maybe then, but even there's been a huge amount of damage to Ukraine that needs to be discussed because they're a huge wheat producer, right? So there's there are real issues that will take time to play out. That to me, like that's where the Fimbulwinter risk is versus a Ragnarok.
Well, and part of that too is like what really always I think about, and you and I have talked about a million times. We've done actually shows on this in the past. Is the idea of like everybody wants to talk about like the Fed or money printing or all this stuff, and it's like it all boils down to food and energy, right? Like if we have a cooling cycle and we can't produce the wheat, or a war happens in Russia and the Ukraine, like if people starve, like that matters more than our financial markets.
Theory, didn't you?
No, I'm just saying, like I have no idea, but like it's just like we think that we have a control, like you said, an understanding of markets. But if you have an exogenous event of actually global crop rotations and planting growing cycles and heat cycles and oceanic oscillations, it's like we have no idea what we're talking about, right? And like we can say, oh, it's the Fed putting their thumb on the scale, but if we reduce arable land, we go into chaos and everybody gets hurt, like, and that's the scary scenarios to me. But like Corey, I was thinking about this the other day. What's your quote on volatility?
I have a quote on volatility. Oh yeah, risk can't be destroyed, only transformed. And
so I was thinking about this is like, so we always talk about that, like they may be able to suppress volatility in equity markets, and then everybody goes, okay, if they suppress it there, let's look at like rates markets, et cetera, like FX markets. Everybody was betting that was where we were going to see volatility manifest. Like you said, you can strain it, but you're squeezing that balloon. But did we just see that balloon pop in commodity markets that people weren't expecting, that just got exacerbated? The camel that broke the straw's back was the Ukrainian conflict. Was that where people weren't expecting it to come from there? And then all of a sudden, is that where we saw, volatility and risk get transmuted?
It might be. I know we just hit an hour. To me, the most important takeaway here is that Jason definitely has a farm somewhere in the U.S. he's not telling us about, Jack. And we got to figure out where it is.
I got farmland to sell you guys in North Carolina. But actually, I'll be honest with you. A good friend of mine, shout out to Drew Knowles, is we were always talking about, buying large swaths of farmland and ranch lands, whether it's in Texas or different parts of the country. And then the question is then, do you fractionalize that ownership? And then using homestead laws, like if shit did hit the fan, if you can get there, it's like, then do you have that community? Do you build that tribe where you have all the sustainable ways to grow the, food and that sharing, that form of co-op that's only really needed for like these interim times until everything kind of recycles and reboots itself?
I feel like I made a big mistake buying farmland in the metaverse.
Oh, that was, we forgot we had breaking news today, guys.
What's the breaking news?
Biden finally came out and gave his executive order on crypto. There's so much for us to talk about there.
Well, he said nothing.
He said he's going to look into it, right? That was the big executive order. We're going to look into crypto.
Yeah, yeah. Jason, also, you're kind of assuming though, like if there is a huge disaster that would cause you to go to your farm, all this cooperation you have with your people who are fractionalized ownership, like I don't know how much peace, love, and happiness there will be if there's a crisis. So you gotta know people. Like it's gotta be.
There's always a rub.
You, me, you, me, and Corey. We're in the fractionalized ownership. But if it's like anonymous and it's just some guy, like
I can't make any promises about my behavior.
Me neither.
Exactly. Corey and I are friends during good times. Wait till the bad times come.
That's right.
I'm gonna eat that big bastard.
Yeah, that's why it's good to have big friends. Okay. Should we leave it there, gentlemen?
With cannibalism, yeah, that's as good a spot as any.
Okay, great. Thank you everyone for watching. Follow Jason on Twitter. Jason, what's at Jason Mutiny? What's your thing?
Yep.
Yeah, Corey at C Hofstein. Follow at Blockworks _. That's on Twitter. Most importantly, follow the Blockworks YouTube channel. In fact, I'm gonna do a very delayed outro, very long outro. Don't forget to subscribe. Click on this. Pirates of Finance will be here every single Friday, 3 p.m. Rain or shine. One of our hosts is out. Our main host, Jason Buck, is out. Maybe we'll take a break that day. I'm actually going to be out in 2 weeks, so we'll have to figure that out. But yeah, subscribe, smash that like button, and just demolish that subscribe button. Thank you so much. Bye-bye.
Thanks everybody for being on.